Hello friends, I hope you are enjoying the holiday season and I welcome you back to another video. Today we'll be discussing UiPath Incorporated, ticker symbol PATH, which is a robotic process automation company that IPO'd in April 2021 and started trading around $70. Since then the stock price has come all the way down to the 40s and it is currently trading around $44 at the time of recording this video. The stock also made a high of $90 in May earlier this year and hit an all-time low of $39.30 just recently. Before going further into this video, I want to mention upfront that I am very bullish on this company, so I already own a small position and I am looking to buy more, especially if the stock price keeps trending lower in the short term. So let's take a closer look at what this company does and how their financials look, to see what kind of return we could expect over the next few years if we invest in the stock now. I will also be discussing an option strategy that can be used to reduce our risk and still have the potential to get a decent return, so please make sure to stick around till the end of the video. I would also appreciate if you could hit the like button and subscribe to my channel, as this will motivate me to make more such videos analyzing different investment opportunities. Okay, so UiPath, as I mentioned earlier, is a robotic process automation company, which basically means that the company offers software that automates different processes that are performed manually by a human user. The parts of the software, which the company calls as software bots, first learns the process by reading into the actions that the user performs on the screen, and based on that, the software automates these processes instead of the user having to do the same task over and over again. For example, a user whose job is to input invoices into an accounting system can use the software to automate mundane parts of this activity, thereby saving significant amounts of time and effort, which can then be spent on more productive and creative tasks instead. UiPath's software platform also integrates with other popular applications to allow customers to automate almost any part of their business processes and make them highly efficient and cost-effective. The company's software platform also has different versions that would appeal to both technical and non-technical users. For example, the Studio X is more suitable for non-technical users, whereas the Studio Pro version can be used by more advanced users to customize the software depending on their specific requirements. The company's customer base is also rock solid and has been growing quite impressively over the years. Currently, they have over 9,600 customers at the end of October 2021. And as you can see here, over 1,300 of these customers each bring in $100,000 plus in average recurring revenues, and also 135 customers each bring in over $1 million in average recurring revenues. These are really remarkable numbers. Another very important thing to note here, that there is a very strong correlation between the company's annualized renewal run rate and the trailing 12-month revenues. What this means is that a significant portion of their customers are bringing in recurring revenues year over year, probably by expanding the use of the software into more areas of their business, as well as by purchasing additional subscription services to maintain and upgrade their software licenses. And as you can see, these revenues have also been growing at a staggering rate of over 60% compounded annually. This shows the strong momentum UiPath has in its favor, and I think we can see many more years of impressive revenue growth as this industry is still in its infancy. Let's now look at the company's Q3 financials, which was published for the period ending October 2021. As you can see here, the revenues were $221 million compared to $147 million year over year, which is an impressive 50% increase. They also have very high gross margins, which is typical in the software business, but it is also encouraging to see that they have turned profitable on a non-GAAP basis, earning $9 million for this quarter, which was 4% of revenues. As you can see in this chart, the company is quickly turning profitable as well as improving their free cash flow margins, both indicating the potential for stronger operating results in the coming years. The company also has a strong balance sheet, with their current assets sitting at $2.2 billion, which is well over their total liabilities of $584 million. So I don't see any risk of the company issuing more shares anytime in the near future and diluting the ownership of existing shareholders. In terms of guidance for the fourth quarter, the company is projecting continued revenue and ARR growth, which if achieved would put the full year revenues at around $890 million. Let's now use these numbers to discuss valuation and use some scenarios to project the company's financials into the future to see if the stock is currently a good investment or not. As you can see here, I have listed 3 scenarios with varying revenue and earnings growth projections and tried to estimate the future stock price in 2026. So with the current market cap sitting at around $22.68 billion, I feel the company is fairly valued and it is pretty reasonable to expect scenario 3 to play out. This would require the company to grow its revenues at an annualized rate of 45% over the next 5 years, which I think is quite possible as there is a lot of room in this industry to grow. But even if we end up with scenario 1, there is not much downside to the stock price. My target price of $83 in scenario 3 is also lower than the all-time high of $90 the stock made earlier this year. So even from a technical and market sentiment standpoint, I think there is a very good chance for scenario 3 to play out, giving us an annualized return of over 13% as long as the company continues to grow their revenues and doesn't make too many operational mistakes. But these are obviously projections, so it is always good to wait for better prices before opening a full position, especially given the current overall market condition, which doesn't seem that favorable to growth stocks. So personally, I have initiated a small position already, but will try and wait for lower prices to accumulate more shares. I'll be adding to my position if the stock dips again below $40, and anything below $35, I would consider that as a great buying opportunity for the long term. And if you like this company, but want to be a bit more conservative, especially if you have a larger portfolio, you could also sell some long-dated put options far out of the money and still get an above-average return at a much lower risk. For example, you could sell the $30 cash-secured put option expiring in December 2022 and collect a premium of around $320 for each lot of 100 shares. That would give you a return of around 11% on the $3,000 investment with a much lower risk, as the stock should drop below $27 in the next 12 months for you to end up with a losing trade when the option expires in December 2022. But again, make sure you have enough cash in your account to cover for any margin required if the stock price drops in the short term. You should also be willing to own the stock around $27 if the price goes below that level before the option expires. And if you're new to options or have any questions about the strategy, do let me know in the comments and I'll be happy to help. With that, I hope you liked this video, so please don't forget to hit the like button and subscribe to my channel. And as a friendly reminder, I'm not a licensed investment advisor, so always remember to do your due diligence before making any investment decisions. That's it for now. You have a great day and I'll see you in the next video.